afternoon, everybody. Pleasure to have you all. I'll cover the first kind of 20 minutes, as Georgia mentioned, around binary capital investment trusts. What are they? What's good in an investment trust? What could be a challenge? And then I'll hand across to Sean to cover more the technical side from a platform perspective, from an investment perspective, as for advisors, whether it's a DFM solution or any other solution for that matter. By way of background, I'm the CIO at Binary Capital. I essentially run the investment business here in London. I've been running that since inception, since we kind of set up. And my background is I've got roughly 20 odd years experience of managing client monies across a range of institutions. Indeed, I started my career in Scotland. I'm Scottish born, and I'll touch on that in part of the presentation, where many investment trusts originate from, are invested in, and managed from as well, specifically Edinburgh in that respect. So without further ado, I kind of crack on with the presentation. So in simple terms, what is an investment trust? An investment trust is essentially a company, a closed-ended vehicle, a company that's listed on a stock exchange. As shares are listed and traded freely as a normal company would be traded. And the thing with that is that company itself invest in other shares or in the stock market or elsewhere for that matter. So essentially like an investment company listed on a stock exchange. And there's many of them in the UK. I've got here a number of 300 or so. So there's a lot of choice out there in the investment trust space, certainly the ones that are listed in that respect. But why are investment trusts, and this is an important point, why investment trusts been not that popular, certainly over the last 10, 20 years? We don't really hear much about them often. They're not in the press. They're not advertised that regularly. And I think that's down to a range of factors that some are highlighted in this slide. And a couple of key ones is this. Typically, over the last 10, 20 years, unit trusts, funds, as one would class them, or OICs, have been popular. I guess, people talk about performance, people talk about investments, people talk about strategy, investment firms. But ultimately, in my view, the investment industry is more of a kind of marketing machine as opposed to an investment machine. One that's got the biggest marketing budget, the biggest, advertising space and messaging often wins in that battle. And performance often, not usually, but often can become secondary in that respect. So therefore, because of marketing, because of the incentives to increase assets under management, and often fee shading, trail commission arrangements that happened historically, investment trusts have been seen as a backwater because of that. So less popular, not really pushed by investment firms themselves in that respect. Post RDR in the UK, roughly 10 years ago, commission sharing, trail commissions, there was more transparency around fees and income and costs. So that's made investment trust a bit more relevant, but still, there's so much product choice out there. I think I saw a number where globally there's around about 100,000 mutual funds. In Europe, there's probably 50,000 mutual funds. So there's so much choice. Where does one even go for in terms of product strategy or genuine product availability in that respect? And to be clear as well, investment trusts themselves haven't helped themselves. They've often treated a discount to the net assets. Historically, some of them have been poorly performing and had less areas to kind of shake up the investment strategy as such, and therefore, investors, why would one buy some shares when the net assets are at a discount to the price of the shares that are listed on the stock exchange, or often investment trusts, some very rarely can be at a premium to the assets because there's a correlation between the share price and the assets, but often that correlation can break in that respect. And there's been corporate actions done or interventions done to try and address these points. For example, there was a very famous one where Alliance Trust, investment trust that's in Dundee, had activists from the US trying to shake up the management of that investment trust quite successfully. It took many years, but quite successfully managed to do that in many respects. So these are the kind of factors why investment trusts these days are less popular or indeed have not been popular for clients and client portfolios. And we here at Bindery are trying to address that. And because we think there's so much alignment between how some of the best investment trusts are managed and how we as a firm want to manage money on behalf of clients. The evolution of investment trusts, kind of briefly touch on this. It's very much a kind of British invention, very much of the kind of British Empire. I'm sure many of us know the sun never set on the British Empire, and therefore, in terms of the capital accumulated, the wealth within landowners, the affluent society 100, 150 years ago, 200 years ago, was then utilized. I guess some of them were, and they were mainly men, sadly to say at the time, used that for overseas adventure. Scottish American Investment Trust used that capital to invest and build up US infrastructure. Scottish Mortgage, a very famous, very popular investment trust, used its capital when it started off to invest in Malaysian or Asian plantations, lending them money from the capital raised. So it's very much a kind of upper, kind of middle class kind of investment strategy for that kind of cohort to really gain returns from what was involving countries then, never mind sectors, countries. But the nature of an investment trust, we believe, have real thinking now in terms of innovation, in terms of strategy, in terms of development, and how one can actually use investment trust now in 2021 for future strategy in terms of corporate. And again, I'll touch on that in a subsequent slide. Brief example of many investment firms that have investment trusts as part of their stable of strategies. They also run unit trust and OICs and other funds as well. Very popular names, very, very credible, transparent, large investment firms here in London as well as elsewhere in Scotland, as I said, Edinburgh, and certainly the heart of it in many respects. And I guess I want to kind of touch on what's the key for us, what's the key value characteristics of an investment trust? What do we really like about investment trusts? Why do we want to invest in an investment trust on behalf of our clients as part of a genuine DFM solution? And why is it popular? I think there's 3 or 4 key points here I want to kind of highlight. First of all, we love the fact that investment trusts have that kind of permanency of capital. Okay, if you want to liquidate, you can liquidate, but there's no issue around having to sell down units or shares or stocks in that respect. You liquidate on the stock market as per a normal stock market, buy and sell exchange in that respect. You don't actually liquidate the underlying shares in that respect. So that's very, very important. And we really like that permanency of the capital base. One can actually grow that capital. Indeed, my first experience of investment trust back in the days was when I started my career in one of the big investment firms that actually does investment trust, Baillie Gifford, was actually to raise capital for Pacific Horizon. We did a CCR issue then at the time. And one of my first tasks in my role was to work out the diluted and undiluted NAV of Pacific Horizon. And I didn't have a clue about investment trust at all, or what even diluted NAV meant. I'm maybe giving away my age, but back in the day, I mean, nowadays, most people would Google that, but the internet was not even invented then. I had to go and ask somebody, old school, had to go away and ask somebody what that term meant. So we love the permanency of the capital and the structure of that. And that permanency of capital is very important, because when we love that capital gives a lot of advantages in terms of the long-term strategic thinking that many investment trust managers can adopt if they so wish to do so. So with that permanency of capital also comes the point that a lot of investment trusts can gear, they can borrow money like a normal company in some respects from a bank. They can issue bonds, for example, debentures, short-term or long-term, and use that borrowing or gearing to invest in some of the best strategies. And we really like that. Use with caution, but I think that's important in some respects. I think a key point about investment trusts is on the right there, as I kind of highlight, where many investment trusts, because of the permanency of capital, invest in private companies. And that's very important, because private companies are becoming very, very popular now to invest in. Historically, that wasn't the case. 10 years ago, it took roughly 5 years for a company to go invest and become an IPO. But now it takes 10 years plus for many technology companies in the US or even China, for example, to list and become an IPO. Some of the best companies in the world are still private. So how do you get access to them? You can't really get access to them through a unitized product, going back to the point about liquidity and going back to the fact that you need to have liquidity there to meet redemptions potentially, and a private company, A, will be illiquid, B, one might struggle to get a valuation for it in that respect. So, and it's risky in that respect. So why would you want to hold it in a unitized structure? And investment trusts, because of that permanency of the capital, is ideal in that respect. Often fees can be very competitive. Going back to the point about Scottish mortgage, the fee there is roughly 0.35 to 0.4%. Very competitive fee for a global investment trust, a trust that invests in the US, in China, with roughly 15 to 20% in private markets, private investments. So where can you get that for a very, very competitive fee? And another thing we like about investment trusts is the independence point that I touched on earlier, that the fact that there's a board there, that board can rotate. You have an independent chairman that is not aligned to the actual management of the investment trust per se. And therefore, if there's underperformance, prolonged underperformance, changes can be made. So you can have good corporate governance as well in that respect for the investment trust. Again, we like that. We like that a lot. And again, the point, I'll reiterate again, we like liquidity. I think investors generally, especially certainly when times are good, undervalue the issue around liquidity, but we like liquidity a lot. And I think that's important in any scenario, whether it's good times or more kind of volatile and challenging markets, bear or bullish kind of markets in that respect. Again, what's good in investment trust? This kind of gives you an example of what we like. I kind of covered most of these points, generally speaking. But good corporate governance is important. Rotation of the board, diversity of the board, experience of the board. One as an advisor, you should be looking at the share classes. Is there dilution effects on an investment trust? What kind of share classes is there out there? Are there warrants out there that may dilute the share class or the share price? Have a look at the premium or NAV or discount to the net asset value of the investment trust. Are you buying at a good price now based on the underlying assets? Or are you paying up too much for what could be a very popular trust, trading at a significant or premium to the assets? And again, gearing needs to be used with caution. It's okay to borrow when markets go up, making substantial returns. When markets sell off, as we saw in March and Feb this year, and laterally, similarly last year as well, clearly if you're borrowing into falling markets, that can be problematic. And again, should be used with caution and needs to be monitored as well in that respect. And and the investment manager, how independent, how credible is the investment manager managing the investment trust as well. And again, the point about private markets again, a very interesting trend that we're seeing and will continue to see, not just this year, into this decade. So again, advisors can use investment trusts for global equity exposure, exposure in global markets, global trends, and seeking the best quality companies out there. That's one of the reasons that we like it. We talked earlier about, 300 investment trusts in the UK. We will probably invest in maximum 8 or 9 of them. So really drilling it down to the top 3%, top 4% out there. And at the same time, there's 100,000 equities or more listed on exchanges all over the world. We want to pick the best 400, 500 equities and have them within our investment trust strategies. So it's really, really focused, very high conviction in that respect. And we believe we get that in investment trust specifically, and primarily through the quoted investment strategy as well that I touched on earlier. Some of the best companies are unquoted. Stripe, the payment services business, ByteDance. Many people have heard of the TikTok social media app. ByteDance is a $100 billion company, but still private, Chinese company. Heartflow, a very innovative US medical biotech company, private, doing some great work. And the point I make there is, if you want to get exposure to them, it's very, very rare to get that exposure in a unitized fund structure. Investment trusts can do that. And some of these private companies, owners themselves, like investment trusts, because the nature of the private patient capital, the way they want to invest in that respect. And another key point I want to kind of make as well is investment trusts are great for giving real estate as a solution. We don't really invest in real estate, but real estate as a liquid asset sits really well within a kind of liquid investment trust and structure in that respect. Some investment trust ideas that we like. Scottish Mortgage, I've spoken about it a few times in this presentation. We think is a great investment trust and will continue to do well going forward. It's great track record. I think the numbers speak for themselves. The chart tells an amazing story, managed by a great team at Billy Gifford in Edinburgh. Some great ideas, some great innovation, real thematic disruption investing there that we really, really like in that respect. Polar Capital, we as a firm like technology anyway, and we think Polar Capital as an investment trust run by a very experienced team as well is a great play on the whole kind of tech thematic global theme around that. You'll note that it's got, I've looked at the top 5 holdings. Those top 5 holdings had results this week, last week, and all 5 of them had significant results above expectations. Indeed, the US ones were 10, 20% often above expectations. So we really like this trust going forward as well in terms of the way it manages the strategy, the way it manages the portfolio and the long-term nature of its framework as well as the performance and track record. Very, very solid in that respect. Touching briefly, before I kind of wrap up, on what we do at Binary Capital in some respects in our investment trust DFM solutions. So for fixed income, we cover that through standard ETFs. We have not found any compelling investment trusts that give us that exposure there. But for all of our equity exposure, it's certainly through the top 7 or 8 investment trusts that we really, really like that I've kind of covered. And again, our approach to asset allocation is very high conviction. As you can see there on that slide, our adventures portfolio has 27% in the US, but as I look through, that exposure is closer to 45%. In China, as I look through, that adventures exposure is closer to 10%, kind of roughly speaking. So we like that. We like very much high conviction, global exposure, and not really being invested in the UK at all in many respects. And we believe some of the best quality investment trusts out there give us that thematic exposure that we like, give us that exposure to private markets that is growing and will grow further, as we progress into this decade as well, and gives us that stability and long-term nature of investing that we talk about all the time, and we really, really like as well in that respect. So again, just a kind of covering off what we do in the kind of DFM space. And again, I can talk to you all afternoon about our DFM strategy, what we do in the active space, passive, ESG, and as I said, in our niche specialism, one of the few DFMs probably in the UK that does investment trusts. But our certainly performance record here is very, very compelling, and hence the reason why we have such a solution for the marketplace. Yeah, but in summary, to kind of summarize my brief presentation, we think investment trusts are very resilient, very compelling, very transparent, liquid vehicles that should be used and will be used more popular going forward. Indeed, Baillie Gifford themselves have a purely exposed private equity investment trust called Shallion, listed in the Gurney Stock Exchange. We have an independent investment trust run out of Edinburgh by Max Ward, an ex-Baillie Gifford partner. We have a personal assets trust, a very safe, stable investment trust that we like, managed by Sebastian Lyons of Troy Asset Management. The whole ESG agenda is now being covered by investment trusts as well. We have Line Trust, probably in the next few months, launching investment trust as well, based around ESG and ESG factors as well. So certainly from a DFM perspective, certainly from an advisor perspective, one should be looking at these products with a closer eye, with a closer view for investing. Certainly if you have a long-term view on markets and strategies, certainly if you want to capture genuine returns away from the hustle and bustle of weekly and daily share price movements that are often random in nature and have got no real meaning from day to day in that respect. And we believe here at Binary, with our specialist knowledge, our experience, indeed our networks in London, in Edinburgh and elsewhere, we are very, very compelling propositions and solutions in that respect, in terms of our strategy, the way we invest in a very patient and focused manner. Like I said, from 300 investment trusts, we like 8 or 9 at best that we'll place in our portfolios, and high conviction, and we won't change that. Turnover of less than 10% in many respects. So a little bit of a flavour of investment trusts, how we like investment trusts, what's good in investment trusts, maybe what's not good in investment trust, and how that industry, that sector, that theme is very, very compelling for an advisor. Has been historically, and we believe will be more so going forward. Certainly the way global markets are behaving, the way global capital allocation is changing now as well as we speak all the time.